International's monthly webinar. Thank you for joining us today. Pride Partners International is a global partnership of firms and specialists in transfer pricing and financial valuation. The association is the meeting ground for professionals capable of facing a challenging business environment, helping them connect to boost their continuous professional development and enhance their technical and human skills and abilities. This partnership is made up of experts recognized by their trajectory and prestige in the transfer pricing and financial valuation fields. Experts that constantly participate in the exchange of technical information, knowledge development, and implementation of global best practices. When a firm joins the PPI partnership, it increases its scope immediately and exponentially. Business becomes much simpler by accessing training, technology, resource optimization, and new business opportunities, among other benefits. We invite you to learn more about Pride Partners International. Contact our agents and be part of the global elite of transfer pricing and financial valuation consulting. Our transmission will begin shortly. We invite you to participate actively by sending all your questions or comments through the live chat. Again, thank you for watching, and we hope you enjoy the event.
Good morning, afternoon, or evening to everybody, depending on where you are finding yourself at the moment. As the topic of today's seminar, I have chosen a transfer pricing model for a producer who meets the characteristics of a contract manufacturer, but who sells and invoices its products directly to external customers, and is doing so according to instructions of its principal. The reason for choosing this topic is the fact that I often encounter the situation described, meant a group manufacturer that sells its production to independent companies on the instructions of its parent company, and thus has to deal with many of the resulting issues. I have also come across scenarios in the past that aim to bridge the outlined problem situations. I would now like to share one of these approaches with you, and would be very happy if you would in turn share with us your views, comments, and experiences with similar models. Whether, for example, such models are in use in your country, or whether, on the contrary, their introduction could, in your experience, cause problems with the local tax authorities, and what kind of problems. The seminar is presented from a recording. Therefore, I will not be able to respond to your suggestions during the presentation. However, the kind PPI colleagues will pass on all your questions and comments to me, and I will be happy to respond to them by email or otherwise. I am aware of the fact that there may be participants among us who are not transfer pricing experts. Therefore, let me first start by briefly introducing the contract manufacturing business model. The contract manufacturer business model consists, simplistically, of a multinational group setting up a manufacturing subsidiary in a particular country. A frequent motive in these cases is to take advantage of the lower wage costs of production personnel in that country, to get closer to the market of the customers, to use the technical capacity and experience of the personnel available in that country, and similar reasons. The location of the contract manufacturer, its production capacity, equipment and technology, the focus of its production program, and so on, is usually completely determined by the parent company, or the principal here. The principal is also responsible for, or arranges for, research and development, building, negotiating, and maintaining relationships with external customers, defining and implementing pricing strategies, and so forth. In contrast, the contract manufacturer is responsible for, quote-unquote, only ensuring the production activity, for the procurement and management of production personnel, and the formal ownership of the production facilities, production equipment, and the results of the production before they are delivered to the next entity on the supply chain. This next entity on the supply chain may be either the principal himself or designated distributors, members of a given multinational group. These entities are those that get into direct contact with external customers who then supply an invoice for the goods produced by the contract manufacturer. The contract manufacturer is guaranteed the sale of all of its production. In principle, he does not produce for stock, except perhaps in situations where the purpose is to efficiently manage and optimize the production process. Let us now have a look at what transfer pricing theory says about the expected profitability of such a manufacturer. As you can see on the depicted chart, the contract manufacturer is somewhere in the middle of a spectrum of manufacturing entities, between the so-called toll manufacturer, who does not own the goods produced and in fact only supplies a manufacturing service, and the full-fledged manufacturer, who in turn holds and owns many of the functions and assets we have listed for the principal in our case. Thus, under normal circumstances, the contract manufacturer is expected to generate a profit in accordance with the arm's length principle. This profit does not need to be substantial, but it should be stable and guarantee the contract manufacturer reasonable remuneration for the performance of its production activities. Transfer pricing theory recognizes that in certain cases, the contract manufacturer may generate a loss. These typically include situations where the contract manufacturer has erred in the performance of its manufacturing function. Some tax authorities also allow the so-called startup losses for the contract manufacturers. What the situation with the contract manufacturer looks like in our scenario. In principle, we can see the same picture, the same portfolio of entities. What has changed, however, is the flow of formal legal relationships. In contrast to the standard contract manufacturer business model, we see that the deliveries of finished products are made directly between the manufacturing entity and the external customers. It is not only the physical delivery of the goods itself, however, but it is especially the transition of legal title and invoicing. They take place directly between the manufacturer and these third-party customers. I see this arrangement very often in Europe in the automotive industry, where various OEM manufacturers supply their products in the form of components directly to the next manufacturer in the line, who incorporates them into their product intended for the car manufacturer himself. The background of the deliveries remains the same as in the case of the classic contract manufacturer model. The entity that ensures strategic roles, negotiations with customers, and the related pricing policy is still the principal. Also, if we look at the, for our needs, very simplified functional analysis, we can see that the allocation of functions, risks associated with them, and significant tangible and intangible assets remained basically the same. Strategy and research and development are provided by the principal. Business relations with external customers, as well as pricing strategy and negotiations with these customers, are ensured by the principal. As relevant, the principal also owns intangible assets key to the success of the business, such as trademarks, patents, production technology procedures, and so on. The manufacturer ensures for the production, including its organization, the provision of production personnel and, where applicable, the input material. In some cases, the material and input components may also be provided by the principal, or even by the external client himself, especially if it is a strategic material decisive for the quality of the final product. This is relevant for both scenarios, however. For the classic contract manufacturer scenario with the sales only to the group, as well as for the contract manufacturer scenario with the sales to third-party customers. What has changed compared to the classic contract manufacturer model is the invoicing and collection of payments from external customers. While in the classic model, it is the principal or the designated distribution company that sells the products and invoices for them, in our case, it is the manufacturing company directly who does so. In this context, it can therefore be accepted that the manufacturer may bear a certain higher risk associated with the management of receivables. However, it is often only theoretical, as these are long-term business relationships between the headquarters of multinational corporations, in which non-payments at lower levels of the organizations would be addressed immediately. I understand that the characterization of a manufacturing entity that sells its products directly to external customers, even under the principal's instructions and strategic management, as a contract manufacturer may be questioned. However, for the purposes of our case study, and in accordance also with the practical situations I have actually encountered, let us accept that this is the case, and that the manufacturing entity fulfills the characteristics of the contract manufacturer even in our modified case. Now, how do we resolve the transfer to the right entities in the group in our model case to the principal of those price components that the contract manufacturer collects from the external customers, but that do not belong to him, as he himself does not perform and is not responsible for the functions they remunerate? Let's demonstrate it again by comparing the classic and modified contract manufacturer scenarios. In the classic contract manufacturer model, we have probably all encountered the situations where the contract manufacturer pays to the central company a number of service fees for partial services performed by the principal. For example, management fees, fees for the IT system and hotline support, technical support fees, fees for central procurement of material, and so on. In the modified contract manufacturing scenario, it is necessary to transfer to the principal further components of the price that do not belong to the contract manufacturer. Additional fees are therefore added to the already listed payments, most often in the form of license fees, for example for a trademark or for a patent relating to a product or production process, or in the form of a commission for brokering the sales contracts. What do these individual payments from the contract manufacturer to the principal cause, however? First of all, each of these payments must be priced in accordance with the arm's length principle. Depending on the local rules, the pricing must be properly documented in a transfer pricing documentation and possibly also supported by the relevant benchmark analysis. Each transaction opens an opportunity for local tax authorities to question and dispute the fee structure as a whole and its relevance, especially on the part of the recipient, which means the contract manufacturer. The tax authorities may also inquire about individual sub-services and their pricing methods. The financial authorities on the side of the principal may tend to the conclusion that the amounts collected for the rendered services did not sufficiently cover the principal's actual contribution to the joint transaction. On the side of the contract manufacturer, on the other hand, the financial authorities may be under the impression that the prices for individual services were too high and do not correspond to the volume and benefit of the received services. To elaborate a bit further on the subject, let's take a brief look at what the courts have said about different types of intragroup payments for services. For illustrative purposes, I have selected a few positions of Czech courts. Given that the transfer pricing rules in the Czech Republic follow the OECD guidelines, we can assume that these positions are reasonably representative for our purposes. So, what have the court said when resolving the disputes between tax administrations and companies over transfer pricing issues connected with intragroup services? Insufficient evidence that the services were actually provided. Insufficient evidence that the services were, or may have been, of any benefit to their recipient. These positions address the substance and benefit tests for the intragroup services, as also regulated by the OECD guidelines. Often, the tax authorities dispute, and the courts agree, the correlation between the amounts invoiced and the volume of services that have been proven to have been actually performed for the receiving party. One of the very common arguments of the tax authorities, which is also supported by the court, is frequent apparent arbitrariness of the evidence submitted by taxpayers regarding the services received, their content and scope, and the price invoiced for these services. In some cases, it is clear at first sight from the submitted documentation that it was only prepared in response to the request from the tax authorities, and the amounts for individual services for individual periods of a tax year were determined in such a way as to sum up to the total fees paid. We could talk about payments for intragroup services for a long time, but that is not the purpose of today's presentation. What has been said about them at this point is, I think, sufficient to illustrate how complex the issue of intragroup service fees can be, and how layering more and more services to reallocate the profit components received by the contract manufacturer through such a complex payments can trigger negative consequences and disputes with the tax authorities. How then to resolve the transfer of those components of the price that the contract manufacturer collects from the external customers, which however exceed his arm's length remuneration? One possible solution of this issue may be the introduction of one comprehensive variable payment, either in the form of a license fee or in the form of a service fee, which would replace a set of different partial payments with one fee. The amount of this payment would be determined as the difference between the profitability of the manufacturer, which he generated through the collection of prices from the external customers, and the profitability that is typical for contract manufacturers according to the arm's length principle. As the actual profitability achieved by the contract manufacturer varies from period to period, so does the value of the fee paid by the manufacturer to the principal. Hence the concept is called a variable service or license fee. Let us now look at how this model works with the help of a simplified graphical illustration. On the one side, we have a contract manufacturer who provides production activities according to the instructions of the principal. The products are sold directly to a designated third party, again in accordance with agreements concluded by the principal. On the other side, we have the principal as the managing entity that has secured the contracts and their specific terms and conditions with the external customers, including all other functions necessary for the execution of the production process, such as research and development, definition of production technologies, possibly also arrange for input material, and so on. The contract manufacturer produces and collects in the sales prices for the external customers the components of the prices that are attributable to the principal. By a process that we will discuss shortly, we have determined a certain profitability range that the contract manufacturer should achieve in accordance with the arm's length principle. This range is defined in the picture by the dashed lines to which the two arrows point on the left-hand side of the figure. If the contract manufacturer achieves a profitability that exceeds this range, he is obliged to pay to the principal a fee. This situation is indicated on the picture in green. This situation is generally assumed to be standard. We assume that the pricing policy managed by the principal aims, in the long term, to ensure that not only the principal, but all the group entities involved in the transaction are properly remunerated for the performance of their functions. The orange color represents the situation where, on the other hand, the contract manufacturer will not be able to realize from the sales prices even the profitability that would be due to him in accordance with the arm's length principle in the proper performance of his obligations. Thus, the color orange introduces into the concept and addresses a situation where the principal's decisions and pricing policies did not allow the contract manufacturer to generate remuneration in accordance with transfer pricing rules. In such a case, the principal is obliged to pay the contract manufacturer some sort of indemnification, a compensation payment, in such an amount that the contract manufacturer achieves profitability at least at the lower end of the market range. It should be emphasized here that the contract manufacturer will only be entitled to the compensation payment in situations where its lower profitability or loss-making position is the result of situation and decisions that belong to the principal. In any event, the model presented here does not abolish the responsibility of the contract manufacturer for the proper performance of its production function. If there was misconduct by the contract manufacturer in the area of its responsibility that resulted in lower profitability, the impact of that situation would first have to be quantified and excluded from the figures decisive for determining whether and what type of fee of one party to the other would be relevant. Now, from the beginning of our discussion, we have used the term license or service variable fee. In which situation is which one relevant? I have seen both models implemented in practice. Probably the first that comes to mind is the variable license fee. This is especially relevant in situations where the functions and contributions of the principal consist primarily of activities that are generally rewarded by licenses or royalties, such as research and development, ownership of valuable technology or brands, under which the products are sold and which have a significant influence on the price for the external customer, or the principal owns a valuable customer portfolio to which, in this business model, he gives the contract manufacturer access. The variable service fee model is implemented in situations where the principal's key inputs, which have a decisive influence on the profitability of the product sold by the contract manufacturer, consist of activities typically rewarded with a service fee. This is, for example, management and technical consulting provided by the principal, provision of central procurement, rather administrative management of external relations, which, however, does not contribute significantly to the overall profitability of the sales, etc. It is probably obvious at this moment that there is no clear dividing line between these two variations of the model. Probably in every type of cooperation between the contract manufacturer and the principal, all the mentioned components will be present. It will therefore depend on the specific given situation and also on the intensity and degree of added value that each of these components bring to the joint business transaction, which variant of the model will be more appropriate to select. Other aspects will also play a role in the decision-making process, such as how each of these fees is taxed by the respective tax jurisdictions. We will talk about these decision parameters in a moment. We talked about the fact that the profitability of the contract manufacturer should be within a certain range. Whatever is achieved by the manufacturer above this specified range will be paid to the principal in the form of a license or service fee. On the contrary, if the profitability of the contract manufacturer ends up below the lower limit of appropriate profitability, he may be entitled to a compensation payment from the principal. The arm's length range of the profitability of the contract manufacturer will be determined by a standard benchmark analysis, which will target manufacturers of a similar product or manufacturers operating in a similar industry. When discussing the simplified functional analysis, we have seen that the function of the contract manufacturer in the here discussed model, it means a contract manufacturer that sells and invoices its product directly to an independent customer, can be expanded beyond a standard palette of contract manufacturing functions, especially by the collection of income from external customers and their management. This fact should be appropriately taken into account in the benchmark analysis. Selection of the benchmarking method will depend on the circumstances and the availability of comparable data. Most often, it will be the TNMM, or the transactional net margin method. The TNMM method examines the net profit margin in relation to an appropriate base, for example costs, sales, assets, and so on, that the contract manufacturer realizes from the transaction. In the case discussed here, the most appropriate basis to measure the profit margin will either be operating expenses. In this case, the examined financial indicator will be the net cost plus markup, or assets owned and contributed by the contract manufacturer. In this case, the examined financial indicator will be ROA or ROCE. Both participating entities, the contract manufacturer as well as the principal, will continuously contribute their activities and generate costs to the transaction. In practice, therefore, it would not be viable to pay the variable fee until after the end of the tax period, when it is possible to determine the actually achieved profitability. Therefore, typically, the model is implemented in a way where the contract manufacturer pays the principal advances or installments of the total annual fee on a monthly or quarterly basis. These advances are determined based on a budget and the expected profitability of the transaction. After the end of the tax period, the real, actually achieved profitability of the contract manufacturer is determined, and it is established whether it is necessary for him to pay additional amounts to the principal on top of the advances, so that his resulting profitability is within the predetermined market range, most often at its upper limit, or whether there arises, on the contrary, the need for the contract manufacturer to receive compensation payment from the principal. The described model represents a complex solution to a specific situation, which entails a number of specifics and may not be completely familiar to all tax administrations. Therefore, it is absolutely essential that the individual aspects, not only of the transfer pricing model, but also of the individual parameters of the cooperation between the contract manufacturer and the principal, are covered by a proper contract between these parties. In the contract, it is necessary to address in detail what the specific responsibilities are on the part of the principal, which may be, for example, securing sales contracts and orders from external customers, securing central procurement contracts for key raw materials, managerial, technical and further support, ensuring for research and development activities, etc. On the part of the contract manufacturer, the responsibilities provided for in the contract will detail especially his contract manufacturing activities according to the instructions of the principal, and his responsibilities connected with the supply of the products to the external customers and with the collection and administration of the payments from these customers. The contract should also describe the mechanism of the operation of the transfer pricing model, including a summary of the key outputs from the benchmark analysis, and also the frequency of its update should be defined in the contract, so that in the case of long-term cooperation, the profitability of the contract manufacturer constantly remains in line with the arm's length principle. Of course, contractual documentation does not replace a comprehensive transfer pricing documentation. This should be prepared as well, and depending on local legislation, at least in accordance with the recommendations of the OECD guidelines, and should include a benchmark analysis and the description of how it was applied in this model. During the presentation, we touched on a number of advantages of the variable fee model in the case of contract manufacturers with external sales. These benefits include, for example, the fact that the jumble of sub-fees is replaced by one comprehensive fee that rewards all key functions of the principal. A big advantage of the model is also the fact that after paying the variable fee, the resulting profitability of the contract manufacturer will be guaranteed within the arm's length range. This is not automatically ensured by a set of partial fees, so it is not unusual for them to be adjusted artificially and non-transparently after the end of the period. From the perspective of the principal, it is also important that in the event that he is obliged to pay compensation payment to the contract manufacturer, this compensation is supported by comprehensive analysis and documentation, including contractual documentation. The principal thus has the means available to defend his position and this payment before his tax administrator. This is again in contrast to the typical situation where potential compensation payments are hastily awarded outside of such a transparently set model. Of course, there are also some areas associated with the model which should be considered before its implementation. We have already touched on the issue of taxation of variable fees, both by the indirect taxes in the form of VAT or sales taxes, and in particular by the direct taxes. In some jurisdictions, license fees will be subject to withholding tax in the country of the contract manufacturer, while service fees will not. This can bring an additional cost to the model in the event that it is not possible to offset the withheld tax on the principal's side, for example due to his negative tax base. For some jurisdictions, it may be appropriate to negotiate the terms of the implementation of the model and the way it works in advance with the tax administrator in the form of advance pricing agreements, or APAs. The APAs can be negotiated unilaterally with the tax administration of the contract manufacturer or of the principal. In this case, however, a bilateral APA makes more sense, where both tax administrations agree on the terms of the model, and thus the companies gain even greater certainty that it will be understood and accepted by their tax administrations. I myself assisted in several bilateral negotiations during the implementation of these models, especially between the Czech and German tax administrations, so I can confirm that the model is generally well accepted by the tax authorities, even if it involves significant financial transfers between countries. This would be all from me in terms of introduction of a model that aims at rewarding the functions of the principal and the contract manufacturer with direct sales to external customers in accordance with the arm's length principle. while simultaneously managing the resulting profitability of the manufacturer. Thank you for your attention. I would love to hear your suggestions and comments, which you can write in the chat. Colleagues from PPI will forward these comments to me, and I will be happy to respond to them by email. Goodbye.